The United States has been in a depression since 2007, and Japan has been in a depression since 1990, 1989, 1990. And that falls out of people not understanding the definition of a depression. So we all know what a recession is, except Janet Yellen. 2 consecutive quarters of declining GDP is a recession. I know there's some bells and whistles, and the National Bureau of Economic Research has got to weigh in. I get that, but we had 2 consecutive quarters in the first half of 2022, declining GDP. There's your recession. Mild, brief, okay, but that qualifies. And Japan has had 8 recessions since 1990. A depression is different because people say, well, gee, if a recession is 2 consecutive quarters or 3 or 4 consecutive quarters of declining GDP, and a depression sounds worse, that must be 10 quarters of declining GDP. But that's not the definition. I use John Maynard Keynes' definition. He said it's a sustained period of below trend growth in which you neither collapse nor return to trend. So it's depressed growth. And the metric there is, if you're capable as a society, and advanced industrial economy should be, of 3.5% growth, or even, but that gap, that delta between 4 and 2, of course, it gets wider. This is lost wealth. We're now into like $7, $8, $9 trillion of lost wealth. Average annual growth from 2009, when that last recession was over, to 2019, just before the pandemic, so 11-year period, was 2.2%. But we should have been running 3.5, or maybe even higher at times. So I would say that's a depression because it's depressed growth under Keynes' definition. So we're still in that. And by the way, the Great Depression from 1929 to 1940 had 2 technical recessions. 1929 to 1932 was a technical recession. 1937, 1938 was a technical recession. But 1933 to 1936, the U.S. economy grew very well. The stock market rallied in the middle of the Great Depression, but that's my point. The problem was it rallied, but we were from such a low level that it's like you fell in a 100-foot hole and you climbed out 50 feet. Okay, nice going, but you still got 50 feet to go. We're heading for a recession. If it's not here already, it's coming very soon. Certainly, first half of 2023, I agree with that. And you were talking about narratives, and I always say, reality always wins, but not on day one. So right now, there are 3 narratives going on. There's the narrative, there's what Jay Powell thinks. And we know what he thinks. I always say forecasting the Fed is the easiest thing I do because they tell you what they're going to do. You just have to listen and believe them. They're going to keep raising rates. They're going to look for the terminal rate. I don't know what it is because Jay Powell doesn't know what it is. But it's the Potter-Stewart approach. They'll know it when they see it. So Powell is determined to get there. In my view, he's already passed the terminal rate because recession's coming off the top. It's not going to be 2%, next month or anything, but it's coming off the top. So then this brings us to the Wall Street narrative, which is, inflation's off the top, economy's slowing down, Powell's going to pivot. This is the pivot narrative. Probably cut rates by, March or April. And if they're cutting rates, buy tech stocks, buy NASDAQ. That's the Goldilocks soft landing. And I can't believe Powell actually said soft landing at the Brookings, but whatever. Maybe he's feeling good that day. So that's Jay Powell's narrative. And I'll tell you what drives it. There's a clue. There's a hidden aspect there that is driving it. We'll come back to that. Then the Wall Street is, you probably are at the terminal rate. Inflation's coming down, so you're going to pivot, cut, and Goldilocks, soft landing, buy stocks. My version is that I understand Powell's path exactly. Wall Street's right that he's probably at or near the terminal rate already. Inflation is coming down already. It's going to come down some more. But where Wall Street is wrong is that this is going to be some kind of soft landing. This is going to be a very hard landing and a very severe recession for a lot of other reasons, including the fact that you're trying to, going back to what we said before, and this is in the book, you're trying to destroy supply inflation with demand destruction. It'd be one thing if you were Volcker and the demand is out of control and you need to crush that, but you're trying to control this inflation with this toolkit. The Fed doesn't drill for oil, they don't run farms, they don't drive trucks, they don't do anything on the supply side. But here's what's driving Powell. It's called the Volcker mistake. And if you go back to Volcker came in 1979, he immediately set out to destroy inflation, started raising rates, and he did. But we had a recession in 1980, a sharp one, that had nothing to do with Volcker monetary policy rates. Jimmy Carter put some stupid order on credit cards, and Americans put some cap on credit card interest. and Americans stopped using their credit cards. And it was like the pandemic. It was like you shut down the economy. Oh, gee, that was dumb. So they fixed it, and it went back up again. But in the middle of that, Volcker blinked. He lowered rates 7 percentage points in the middle of that 1980 recession. But inflation wasn't dead, and it came roaring back. And then he had to take it up to 20 to finally kill it. And I talked to Volcker about this. He said, yeah, that was a mistake. And Powell knows that history, and he was around too. And he doesn't want to be that guy. He doesn't want to be the guy who blinks early. So while Wall Street's saying, hey, you got it, you're at the terminal rate, inflation's coming down, he's like, that's what they told Volcker, and Volcker pivoted, and it was a major blunder, and it was much more painful to fix it the second time than if he had just persisted in the path. Powell doesn't want to be that guy, so he won't blink, and he will raise rates in February and March, but by then it will be way past the terminal rate. He's already been raising rates into economic weakness. Now he's going to raise them into a recession. I'm a critic of Milton Friedman in some way. He was a great humanitarian. As an economist, I have a few criticisms. One thing he got right that everyone agrees on is that monetary policy acts with a lag, an uncertain lag. Well, I'm sorry, you started raising rates in March. The policy rate on March 1st was 0. Now it's 4.25. It's going to be 4.75 in a couple 10 days or less. And to go from 0 to 4.75 in 8 months, 9 months, that's more than Volcker did. He eventually got much higher, but Powell is determined to avoid this mistake, what I call the Volcker mistake, and he's going to keep raising. Now they will pivot, but it'll be too late. It'll be after the damage is done. But these things don't happen overnight. Everyone's like, you wake up the next day, oh, it's all good. What people don't realize, and just the data's here, just look at it. So the 2008 global financial crisis, everyone knows, September 15th, 2008, midnight on a Sunday, Lehman Brothers files for bankruptcy. It was electronic filing. They shot it in around midnight on a Sunday. But that started in July of 07. There were the two Bear Stearns hedge funds collapsed. I think it was Societe Generale closed a money market fund. They closed the gates on a money market fund. And then, Jim Cramer's on with Aaron Burnett, and that was just, they know nothing, they know. He was actually right about that because he was talking about the Fed. And then Bernanke cuts, I guess, the discount rate, which is kind of irrelevant. But Bernanke's on the record that whole summer of 07 saying, yeah, we got some stress in mortgages, but it'll blow over. So when did it hit the peak? Well, the answer was a year later. It took a year for that to go around. Remember Hank Paulson's Super Civ? That was September of 07. The stock market peaked in October of 07, 6 months after the crisis started. That's when the stock market peaked. Then in December, they went around. I talked to some of the seniors who did this. Temasek, Kuwait Investment Authority. They went to the major sovereign wealth funds, and they basically bailed out Wall Street at that stage. And then it was quiet a little bit in the winter of 08, but then boom, Bear Stearns in March, Fannie and Freddie in June, and then Lehman in September.